G'day everyone, welcome to the weekend general update for the 19th and 20th of January. And the breakout above 1475 resistance on the S&P that we've been waiting for now for several weeks was basically confirmed during the week. So we have just yet another set of green lights going now. We've got confirmation in many areas, and I want to have a look at a number of those charts. So certainly 2013 is setting up to be the most positive year that we've seen since the 2009 rebound from the GFC. So pretty good times, but nevertheless markets never go up in a straight line, so there is a way to trade and invest in a smart and intelligent way, and that's what I'm endeavouring to convey via these weekend updates. So let's just have a quick look at what went on last week. First of all, just a reminder, this is general advice only. So the weekly summary, the S&P index has risen 87 points in less than 3 weeks since the start of the year, and that really is quite a substantial gain. The price ran up to form a double top and hit resistance around 1470, but did break through that in the last few days of last week. And so to my eye, it's on the way to challenge the 2007 highs that occurred before the GFC, and they're the all-time highs in the stock market as well. Now encouragingly, both the Nasdaq and the Russell 2000 indices are both supporting the market strength, and it's always a good sign when the small and mid-cap stocks and the technology stocks are leading the way, because that's generally indicative of a fairly healthy market. Now inevitably at times like this, when a new bull market is starting, there are still a lot of people that are negative on the market. They want to point to all of the negative indicators that they can. And yes, there still are some negative things out there, but it's just so typical that markets in the early stages climb what's called a wall of worry. People are always looking over their shoulder, always concerned that the market may take a sudden and sharp reversal back down again. And whilst we will get corrections of 5 and 10%, there's absolutely no question about that during this year. The volatility and the huge swings that we saw in 2010 and 2011, I believe, will be completely absent. So I expect to see 2013, as long as you do things in a patient and disciplined way, as the most productive year that we've had in the last 4 or 5 years. Now our index gained 62 points on the week, and it's been almost a straight line rise since the middle of November. So it's been a very positive response from our market. In the short term, it is overbought, so you really don't want to be buying too much just at the moment. You want to be waiting for a bit of a downturn. We started positioning fairly strongly back in August, and it served us fairly well during that period. Now the US dollar still in a fairly broad range. The direction on the big picture level is still down, but in the medium term it's really in a broad sideways range. Gold gained $23 for the week, which was a more positive performance, and it looks very much to me like the price of gold has based, and it really is just looking for a trigger to go higher, because certainly all the fundamentals would point to gold going higher. All the money printing really just has to fuel inflation. We haven't seen it yet, and it may still be potentially another year or two away because of other things that central banks are doing. But it is coming. We will see significant rise in inflation in coming years. Negative real interest rates are probably the environment that has been shown to best suit gold. Gold really outperforms in negative real interest rates, and we've certainly got that in most of the developed countries around the world. Plus we've got China importing stacks and stacks of gold now as part of a bigger term currency strategy that they're working on. So really I can't see any reason why gold is not going to continue to push beyond $2,000 an ounce. Copper, which is an indicator of the level of global economic activity, has been steady around the 350, 360 mark now for quite a few months, and has really shown little sign of downside. Oil has risen back up to 94, and I don't think it's going to go too much above $100 a barrel, given what's happening in America these days with all of their gas and oil reserves growing by the day, but nevertheless it'll remain pretty solid. This is the spot copper chart that shows you it's really been around this 350 to 370 area now for, well, really since about the middle of last year. Looking at the overall strategy before we go to the charts, to me inflation is an absolute certainty in the future. We just don't know when exactly it's going to happen, but it's already baked into the pie, I can assure you. There's no avoiding it. There's been so much money stimulus put into the system that inflation in the future is a given. And in that sort of environment, people that are holding bonds as a form of safe haven investment are going to get absolutely killed in future years. So my absolute conviction is not to be in bonds at this point in time. Now, money printing will continue. I believe that's a long-term trend, and in conjunction with currency valuations that basically are being conducted by the central banks of America, Europe, the UK, and now Japan. So if we look at where the money flows are going to be going, I believe money will start to come out of bonds. People will be forced to become more risk-seeking, and they'll also be wanting to come out of pure exposure to paper currencies as well, as they recognise that this ongoing currency war that's going on just will continue to devalue the purchasing power of paper money. So money flows, I believe, over the next few years will go increasingly into risk assets such as stocks and gold and silver. So looking at which stocks will perform best, I believe yield stocks will still perform quite well, as the global mindset has taken a long-term, multi-decade change, I believe, since the GFC. People are looking for a return on their money in terms of month-by-month cash flow these days, rather than relying on capital gain. And once those mindset shifts take hold, they're not short-term. This is going to go, I believe, for a decade or two. Now, the issue, though, is that many are fully valued or even overvalued. There are some great yields, or some great businesses in Australia that were paying good dividends, but the share price has gone up so much now that the dividends have come down, and the stocks are certainly very, very fully priced. Now, I believe resource stocks are still only in the early stages of a significant rebound, thanks to the turnaround in China and thanks to the growing global economy. So that raises the question how to buy these stocks. Well, you've just got to be patient for the dips. Our market's had a heck of a run, as we'll see from the chart in just a minute. And I don't know when that dip will come. It might be this month, it could be February, could be March, but I would not be going too heavily into the market at this stage on these stocks that are fully valued. There are still a few stocks that are good value, but there's not that many of them at the moment. So it is easy to pay far too much, even for great companies. And if you pay too much for a great company, it can still be a really bad investment. So I think good times in 2013, but still needs some patience and discipline. So let's have a look now at the charts. We'll start with the S&P 500 index, and you can see, I'll just pan back here, we had this medium-term double top here that the market had to get over. Above that we've got future resistance at around 1520 and then about 1570. But as you can see, we've had a very strong run since the 16th of November in the S&P. It ran up to this resistance. It spent about 4 or 5 days just pausing at that resistance, not very much downside, and now it's broken clearly to the upside. Starting to get a bit overvalued on the RSI, so I wouldn't be surprised if it ran for maybe another 10 or 20 points, perhaps poked its nose just above 1500, and then we got maybe a 4, 5, 6% correction in the S&P. So that would probably set up some better entry opportunities. Just looking at the US dollar index, we pan back, you can see we have definitely a long-term downtrend. Further back we go, the more obvious that is. In the medium term, we're in a broad sideways band, but I believe it'll just be a matter of time because the US Fed and the US government wants the currency lower. There's really little question about that. Now I mentioned the NASDAQ and the Russell 2000 index. This is the NASDAQ, is now at all-time highs. So we've now exceeded the highs that the NASDAQ was at prior to even the 2000 tech wreck in the technology stocks. So you can see that's been an incredibly strong run since the middle of November in the NASDAQ. And similarly, the Russell 2000 small and mid-cap stocks, you can see there's a pretty good trend underway there as well. They're all fairly overvalued, but they can remain in that position for some time. Let's have a look at the UK index, the FTSE index. Was in a broad trading range for quite some time, but broke above that with a very, very strong move on the 2nd of January and continues to push higher. So despite the fact that there is a lot of dire economic circumstances in the UK, the share prices are still looking ahead, 6 to 9 months ahead, and foreseeing that things are going to improve in the UK. The Shanghai index has also turned around quite abruptly. It was in a decline for much of 2012. That's turned around now very sharply, and that's certainly in conjunction with better conditions in China. Let's have a look at our index. So here was the turn here on the 16th of November, which is a pretty pivotal day. You can see our market index, which is really just reflecting the banks and the resource stocks, has pretty much gone up in a straight line. Now there'll be some resistance at around 5,000 points. Just put a horizontal line across there, so just under 5,000 there'll be some resistance. So we'll see how our market performs around about that time. And just looking at our market on a sector by sector basis, I want to have a look at the best performing sectors over the last 12 months, starting from a common index point. The line at the top is the healthcare index, clearly outperforming. Underneath that we've got telecoms, also being a very strong performer. Underneath that the banks, and then we've got quite a substantial gap down to the small cap index, but it's also been doing reasonably well in the last few months, and it's kept pace with the other indices. Energy and resources have definitely lagged, but you can see they are tracking up at this point in time. Let's have a look at gold and silver. This is gold on a weekly basis. We had a tremendous run from 700 to 1900. This correction is going on a little longer than I would have expected, but there are certainly some vested interests that are working to hold the price of gold down. But eventually the market forces will cause gold to break out, and I believe above this $2,000 mark. If we look at this on a daily chart, you can see we're almost out of this short-term trading range here. We just needed to move above about 1700. But silver is definitely outperforming gold over the short term, and we had quite a strong reversal here a couple of weeks ago. And if we go and have a look at a chart of gold versus the HUI index, you can see with the HUI index, which is the world's largest gold stocks, started to underperform again back in October, but has really stabilised now, and I would expect, as we saw here in May and again in July, I would expect to see gold stocks start to outperform the price of gold. So that's it in terms of the the charts and the update for this weekend. As I said, pretty good times ahead. So we'll talk to you again next weekend. Cheers.